Hey everyone, welcome in to another daily editorial here on the KE Report. Corey and Chad here chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, we are chatting with you off mic before recording for quite a while here, talking about, well, initially we started looking at the gold chart, the silver chart, GDX, GDXJ, and then you made a comment that you don't think the charts are maybe as important as they normally would be to someone like you, a technical analyst, because you're focused a bit more on the macro environment, what's going on in the economy, and this whole forward-looking projection of the Fed pivoting, starting to cut rates, and a more severe recession hitting the U.S. Now, I just want to ask you, from a technical analyst standpoint, I don't usually hear you guys say, I'm kind of not paying as much attention to the charts. I'm looking at some other economic data. I'm projecting further out what could happen in the economy more so than letting the charts tell me maybe what they're discounting in the future. Jordan, explain to us how you're balancing out reading the charts, using your technical and analyst background, but also putting what sounds like a little bit more weight in the economy, where you think the economy is going.
Well, I think the problem with a lot of technical analysis and technical analysts in general is they only want to be charts only. And so they place 100% of the evidence on technicals. And I try and look at everything and align the fundamentals and the macro to what the charts are saying. So I'm not trying to diminish the charts. More so, I'm trying to take a more holistic look, you could say, by looking at everything. And so, the idea that the stock market could be in a new bull market, I think that's really misleading. I guess based on these, 20% definitions, it could be true. But if a technical analyst is telling you, the stock market is in a new bull market, this thing can really run here. Why do you want to miss out? Well, there's so many other things you have to look at. And I think, historically, you could look at and say, well, there was a new bull market after 1998. That didn't last that long. I think 1966 is a reasonable comparison. I was looking at that yesterday. The time between the 1966 peak and then the late 1968 peak, I think was like 2.5 months or a little bit more than that. So when people are saying there's this great new bull market, I mean, that's fine. And it might be technically correct, but you're not looking at a bunch of other things like, the yield curve is inverted and all, the LEIs are in the toilet. And so you're looking at all these things and they're basically telling you the odds of a recession are really high. And what I've been saying in recent months is it's really a question of the timing. So yeah, you're like, okay, there could be a new bull market, but if there's going to be a recession, the new bull market is really not going to last that long. It's not going to be meaningful. And, I just looking at the S&P, it's already rallied 27%. So people are saying, great, there's this new bull market. The S&P's, hit 4,400 or almost at 4,400. It's already made a big move. And then at the same time, you have to look at things like intermarket analysis. Like if you're looking at the mid 90s when gold had this failed breakout and it really dumped hard, you didn't have an inverted yield curve then. The big picture technicals on gold were not as bullish as they are here and now. I mean, for example, looking at gold here and now, yes, gold's been consolidating and correcting for almost 3 years, building this handle on a cup and handle pattern. And, gold, what the 38% retracement is, I think 1675 or something like that. I mean, gold's in the 1900s. So gold is held in the very big picture. Gold has held up really, really well. I mean, if gold was like below, or it looked like it was going to go below 1600 or something like that, or go to 1500, then you could, might look at the technicals and say, well, that looks really bad. That supports the stock market. Maybe, and if the yield curve wasn't inverted, maybe you could look at those things and think, okay, well, maybe this bull market could run for 2 or 3 years. So I don't mean to trail off here, but my point is you really have to look at the macro, the fundamentals, the technicals, the positioning, and get a sense of history to kind of understand where we are. And in very big picture, the S&P has rallied several times from the 40-month moving average, which is my demarcation line for secular bull and bear markets in the S&P. In the meantime, gold has failed to break out. So that tells us the secular trend hasn't shifted yet. But, gold is still holding up really, really well in the big picture. And you look at the stock market, you consider, the LEIs, the yield curve, all these things are telling you recession is coming eventually. So I think, and yes, you look at those things, and then you look at the price action, the S&P, and that tells you, well, if a recession is not going to come, like let's just say it doesn't hit until Q1 of next year. Yes, I mean that's some time where the stock market, could have a good run for another 4 or 5 months before that happens. So I'm not trying to diminish people who are saying it's a new bull market, but I think you have to provide context to that, and you have to look at everything else that's going on rather than just say, well, it's a new bull market, nothing else matters, and I'll just buy and hold until it rolls over, and I'm going to know when to get out before whenever the recession starts. I mean, that to me is just, it's like dangerous thinking. It's really too simple of a process.
Well, Jordan, I think you make some good points there. But just to clarify, I mean, some of the guests we've had on have mixed a lot of macro fundamentals in with their analysis for the technicals. And when they look at the fundamental analysis, it's just like any market. There's bulls and bears on either side. They point to the fact that so far the jobs market has been good. The consumer has been way stronger than people expected. Retail sales haven't been as disappointing as many were expecting. Earnings and the Q1 earnings and the Q4 earnings of last year weren't as dire as people projected. The banking issue seems to have cooled down some, even if it's not over. And they point to the fact that look at cruise lines, look at airlines, look at vacation, look at travel. People are still going out to eat. There's still people piling in, not just to the markets, but in the economy. And a lot of them say when they just, go out and live their lives, people are still out, and it doesn't seem like a recession. And we're not seeing it in the GDP getting weak like it was the beginning of last year. And they say, look, the yield curve's been inverted for over a year now. People have been pointing to that, but it still doesn't seem like the recession is coming up to where it's going to be big enough to get the Fed to change policy yet. So, that's kind of how they're looking at it. Do you think that some of it is just which data people decide to highlight when they're cherry picking to make their prognostications about how the economy could develop?
Yeah, I mean, I think they're cherry picking data. Some of those, like the jobs, is a lagging indicator. You go back to the 70s and during inflationary periods, the jobs numbers actually didn't start to fall off until after the recession started in the 70s. So that's one thing. A lot of the stuff that they're talking about, that you're mentioning there, is anecdotal. It's not really data based. And some of the other stuff is fine. I mean, some of the other stuff is telling you, I mean, that stuff is already discounted by the market. The market is looking ahead. So the market, it's fair to say, the way the market is moving, it obviously doesn't see, what I've been using in my writings, the recession is not imminent. And so the market is reflecting that, because if there was going to be an imminent recession, bond yields would be tanking, the stock market would roll over. Clearly, the market is not seeing that. And so that tells us, again, it's not imminent. And, we're here at the end of Q2. So, maybe Q4 is the earliest that it could happen, maybe Q1. But all the stuff that those people are mentioning, if you want, like, or if you think there's going to be a real new bull market, like, where is the new expansion going to come from? The thing about the consumer, all the pandemic cash, they've been spending that's going to run out towards the end of the fourth quarter. I know that's one of the points that you mentioned. So that's one thing. If the Fed's not going to cut, there's no stimulus coming from that. The banking situation, one issue with the yield curve, we were talking about this beforehand. The median of all these historical inversions points to September. So we're still 3 months away from that. And also, if you look at the 3 month to the 10-year, I think 4 of the last 6 or 7 instances of inversion, like the time, if you look at the time when that inversion happened, when the recession hit, like if you look at those, that would point to, like, I think November or maybe even December. So some of the things that those people are, it's not a really strong argument that they're making, in my opinion. I think it is fair to say that, yeah, the recession is not imminent, and that's why the market's going up. But no one could really make a case that, well, the economy is going to get much better and we're going to have this great new economic expansion starting up. There's really, little fundamental case for that. But, thinking of what these people are saying, what I'm saying, yeah, you can meet in the middle somewhere saying that, yeah, the recession is delayed. It's not going to happen until, Q4 or Q1 of next year. And that, that can give the stock market some time to certainly trend higher. But it's just, I think it's, people have to be really careful about getting too bullish on stocks, especially after the S&P is already up 27%. Bank lending, I mean, that's going to be a problem in the coming quarters. So, I mean, that's how I see it. I don't think anybody who thinks there's going to be a new 2 or 3 year bull market. I mean, there's really no fundamental evidence that points to that.
So, Jordan, if it is still a waiting game for the gold investors, which I know they don't necessarily like hearing because they feel like they've waited for so long already, if we don't want to look directly at the charts, I kind of want to. How much lower could gold go? How much lower could silver go? Could gold go down into the, let's say, mid 1800s? Could silver go back to the teens? Could GDXJ further break down from here? Do you have any levels that play into this overall narrative that, yes, we might be waiting for a little bit and there might still be a pullback, but you know what? These are reasonable levels for that pullback to bottom out at?
Well, even a month ago in my work, a lot of the support levels pointed to the mid 1800s. Like if you look at Fibonacci retracements or really long-term moving averages, they're all kind of coalescing around, I want to say 1840, 1850, that area. So, I mean, gold could come down there and there really wouldn't be any technical damage if that were to occur. And at the same time, gold is still, I mean, I haven't checked it this morning, but it's still above 1900, 1930, 1940, whatever it's trading at. And that despite the fact that, the Fed hasn't cut yet, real interest rates haven't come down yet, the stock market is, up 27% off the bottom. So you factor in, and then the Fed's going to hike a couple more times. At least that's what they're saying. So you're looking at that narrative, and you're looking at how well gold is held up, and it still has room to decline, where you could still make the case it's held up really well. So I mean that's something you have to keep in mind. As far as silver, I mean, I see a lot of support around 20. Looking at I think a long-term weekly and monthly chart. Right around 20 is really significant support. I mean, kind of in the more short to medium term, 22 is an important level. I mean, the 200 days at 22.35 now. So that's a level to keep in mind. But yeah, certainly, and I've been saying this in recent weeks, certainly gold and silver, there's room for them to move lower here. And there's also room for the miners, I think, at least the ETFs, there's room for them to move lower. But I will say, because we're talking about the macro and when the recession could come and all those things, people have to be careful not to get too bearish, I would say, because if gold continues to hold up really well, even as we go into the end of the summer and it looks like the Fed's going to be done hiking, if anything happens, you have another problem with the banks or the economic data starts getting worse, these things can trigger gold to move up to a breakout, fairly soon. So, I mean, it's good to understand all these scenarios, but I just, the case for like this great new bull market that's happening, I just think it's pretty flimsy. I'm not saying the market can't continue to rise and suck more people in, and maybe the rise continues for 3, 4, 5, or 6 months or whatever. But given where the economy is trending and all this data, the yield curves, the LEIs, et cetera, I just, and how well gold is holding up, I just wouldn't want to throw in the towel on precious metals and like jump into the stock market. I think that could be deadly over the long haul.
Okay. Well, Jordan, we'll wrap it up here. Again, kind of a shift away a little bit from the charts. And you are right. Gold, silver, they have held up well in the face of this rising U.S. market. But I think the biggest problem is the stocks haven't done anything, and they have, I think, drastically underperformed the market during this last move higher. clearly investors chase price, and price has been doing better things for them in at least some stocks in the broad averages, and now a bit more breadth as well. So the look to the second half of this year has not changed. We are just waiting more so for that recession, the Fed pivot, more interest to come into gold. We'll see when that happens. Jordan, thank you as always for your time. I hope you have a great rest of your week. We'll chat next week.
All right. Thanks, guys.